Today, we're joined by Dr. Robert Kunnen. For those of you who may or may not know, Bob and I are related. He married my younger sister, so he is my brother-in-law. So I have all sorts of stories that I could share with you. So if the program gets boring, I can fill in the boring parts and share stories. Bob is an economist by training. He did his master's at Western Michigan University, and then he got his PhD in economics from the University of California in San Diego. For many years, Bob was the director of adult and educational learning for business and management at Aquinas College, where he developed a robust curriculum and probably one of the first kind of executive MBA programs in the Western side. In 1986, he left Aquinas College and he joined Principal of Iowa as their chief strategist and economist. And he did that for 25 years, and then he joined AIG, and then he joined American Enterprise, all dealing with the economics of the situation and how do you develop strategies that would allow those companies to be successful. So please welcome Bob Kunnen.
Thank you, Richard. I should mention that I have to pay Richard for introducing me. So I'm going to be doing his lawn all summer to compensate him for doing this. So he drives a really hard bargain. First thing I want to say to everyone is I applaud you for signing up for this. This is not the easiest subject, but it's becoming much more pertinent when you start reading all the stories about debt and devaluation that's going on right now. The amount of debt we've accumulated in the last 10 or 15 years is almost unheard of. And when I look at the projections going forward, it looks to me like we're going to continue to accumulate debt for some time to come. I want to mention one thing. I found it interesting when I looked at the schedule a few months ago that they scheduled this on April Fool's Day. I think Ian was trying to deliver me a message, but anyway, this issue I think is very pertinent. We're now up to 34.5 trillion. I think we've accumulated about $6 trillion of debt in the last 3 or 4 years. I read a article this morning from the Congressional Budget Office. They just issued a new report. They're estimating by 2055 that we're going to have $150 trillion of debt if we don't do anything to address this in the near term. All I can say is that $150 trillion of debt is going to create monumental problems throughout the U.S. economic system if we don't get a handle on this pretty quickly. There was a article in the Wall Street Journal a couple of weeks ago, and somebody mentioned that when we start talking about new programs, we should require the sponsor of those programs to list all the zeros behind the numbers. So what happens is that they cut it off. They'll say the new cost of this program is 1.7 trillion. It doesn't mean a whole lot. But when you start looking at how big that number is, and I put that on here, this $34.5 trillion has 12 zeros connected to it. When you see that number, it has an entirely different meaning to it. And just for the heck of it, after this session, you go home, try 150 trillion, and then put all the zeros behind it and see what that looks like. It's pretty significant to say the least. But I'm also going to talk about some other things related to this. I should have mentioned back with the CBO thing, they're estimating that if this number comes about 150 trillion, the debt to GDP ratio will be 165%. We will be the highest country in the world in terms of the amount of debt to GDP if that were to happen. So, I don't think we're in a position right now where we have to worry that the government's going to default on the debt. I don't see that happening in the short term. The problem is that this is going to continue to escalate over the next 5 or 10 years and it's going to limit the policy options that are available to the federal government. But it's more than just this. It's more than just the federal debt. If you look at the amount of consumer debt, whether it's credit card debt, installment debt, corporate debt, it has gone up significantly. I spent a number of years, as Richard said, in the working for a couple of different insurance companies in Des Moines, and I still go back and talk to some of my old colleagues. They tell me that the number of defaults that they're seeing in their corporate bond portfolio or commercial property portfolio, those are going up significantly right now. If you look at the most recent employment rate, the number of companies that are laying off employees is escalating significantly right now. I'm sure you're all aware of what's going on in California where they passed this new minimum wage thing. Well, you got all kinds of fast food restaurants and other things out there that are getting rid of employees as fast as they can because they don't think they're going to be able to survive unless they make some significant cutbacks. So I'm going to talk a little bit about those issues. I think the important thing to remember is it's probably not going to have a dramatic impact on all of us. Those of us who are over 65, we're going to do just fine. It's our kids who are going to have to deal with this down the line that I'm really worried about, because things like Medicare, Social Security, and other government programs are going to be very much endangered by what could happen if we don't address this. Just recently, getting ready for this, I sent out a bunch of letters to a number of senators around the country, also to congressional representatives. I probably sent out 70 or 80 letters. I got back a response from every one of them, a form letter. It said, thank you for submitting your concerns and so forth. We'll certainly take this into account, but not one of them spoke to the issue. And, you know, it's a little disturbing when you take all the time to send something like that and you get a response back like that. So anyway, I'm not sure that individuals in Congress, whether it's the Senate or the House of Representatives, are taking this as seriously as they should. And when you think about it, why would they? Their goal is to get reelected. Are you going to get reelected by talking about having to cut programs or raise taxes? Probably not. So until there's a really serious problem, I'm concerned whether or not this is actually going to be going to be addressed in the short term. I want to define a couple of terms for you that I'm going to be talking about. In the past, when we had fixed exchange rates, there was something called devaluation. You know, you'd have a country that would devalue their currency. They would say, you know what, we don't like the trade balance with this other country, so we're going to devalue our currency to try to improve our situation vis-a-vis another country. The problem with that, and that went on for a long time, is that you get double cross. Some of you were aware of game theory. If I devalue my currency, more than likely the other country is going to restrict the imports into this country, or they're going to devalue their currency at the same time. Well, that's a zero-sum game. If everybody does that, you can imagine what kind of chaos you have. So we've kind of moved away from that situation. I think more and more people have recognized, countries have recognized, that's probably not a very good strategy to pursue that right now. Now we have depreciation. And that is, if a country gets into a situation where their economy is not doing well, or they attempt to print too much money, their currency depreciates, and that presents a whole new set of problems. So when I use these terms, devaluation and depreciation, today they represent pretty much the same thing. So if I start going back and forth between those terms, that's what I'm alluding to. The US has been in a depreciation situation now for some time because of concerns about the economy. when you look at the amount of deficits we have been generating, that's caused a lot of consternation around the world. And to the extent we continue to run huge deficits going forward, our currency will continue to depreciate against these other currencies around the world. So I'm really concerned about what's been going on as we continue to run more and more deficits. Joe Biden just introduced a new budget a couple of weeks ago. He's projecting a $1.7 trillion deficit in this fiscal year. That's on top of the $2 trillion deficit we had last year. Having looked at that budget, that $1.7 trillion is way too low. I think it's highly likely that we're going to end up well above $2 trillion this year. And part of the reason is that the economy is likely to slow down in the second half of 2024, which is going to affect government revenues and so forth. So again, as I said earlier, I see these deficits continuing to accumulate going forward. All of that is going to cause our currency to depreciate even more. When that happens, ultimately the standard of living in the country that experiences currency depreciation goes down. And that's disconcerting because we already have a situation in this country where a lot of people are not doing that well. If you look around and you look at real incomes and so forth, except for the people at the top of the food chain, they haven't done all that well. So this is a little disconcerting given the direction we're going here. These are the factors that devaluate the dollar. Monetary policy. In 2020 and 2022, that 2 or 3 year period, we increased the money supply by 26% plus. Now, given that we were going through COVID and all of that, there was a reason why the Federal Reserve was very concerned. And so we had this mass expansion of the money supply. Well, surprise, surprise, what comes out of that is 8% plus inflation. And the Fed toward the end of 2022, they said, we got a problem. We went way too far. We need to back that down. So now, in the last year and a half or 2 years, they've actually lowered the money supply by about 4.5%, but we're still up 21 or 22 or 23% versus where we were at the beginning of 2020. The rate of inflation's been coming down, but there are probably some other reasons why that's been coming down. And a lot of it has to do with supply channels and so forth have improved in the last couple of years. But imagine what happens if we get into another significant slowdown over the next year or two and the Fed decides that they've got to increase the money supply again. There's a high probability we could get back into the same situation, having a lot more inflation going forward. Rising prices. If prices go up, there's a high probability that you're going to have a depreciation of your currency. And that's what I talk about in the second thing. High prices devalue the currency. Demand for the currency is another big issue. And I'm going to talk in a few minutes about the countries that are trying to get the US dollar removed as a reserve currency around the world. And that is gaining steam right now, that other countries do not want to have the US dollar to be the reserve currency. Economic growth. If there's slowing economic growth, there's probably a high probability you're going to have depreciation in the currency. And of course, we saw that in the last couple of years. So again, if we go to a situation where the growth in this country goes from 3 or 3.5% down to 1.5%, there's a pretty high probability we're going to continue to see some more depreciation in the currency. Export prices is another big issue. When prices go down, it's highly likely that the value of our currency is going to go down as well. So these are the factors that affect the valuation of the dollar. Now, some people will argue that, well, if the value of the dollar goes down, it makes our goods much less expensive to other countries that want to import those. The problem with that is that if they're investing in the US, they're trying to import things into their country and so forth. That's not always such a good situation. So this becomes a situation where the Fed has to monitor this very closely. This is one of my favorite charts. This has to do with what's happened to the dollar going back over a number of years. And if you look at this, surprise, surprise, when we went off the gold standard in 1970 or so, the dollar began to take a big hit. Not surprisingly, that was at the same time that deficits began to go up significantly in this country. As I point out in here, in 1981, which was the first year of the Reagan administration, we got to $1 trillion in national debt, 1 trillion. That's after World War I, World War II, the Korean War, the Vietnam War, a depression in the 1930s. It took us that long to get to $1 trillion of national debt. Fast forward 44 years, we're at close to 35 trillion now. And if you convert those 1981 dollars, that 1 trillion, and adjust it for inflation, that would work out to about 5.5 trillion. That means we're about 6 times as high in terms of our deficit as we were in 1981. So we're in a situation where we're financing more and more through deficits, all the government programs and everything else. And again, I'm going to talk about why that is going to become very problematic. So that yellow line you see is about the time we went off the gold standard, and you can see what's happened to the dollar since that time. And that's not going to change. It's probably going to accelerate going forward. So this situation of chronic deficits is going to increase devaluation going forward. I pointed out earlier that we had a $2 trillion deficit last year. The rest of the world is losing confidence in our ability to manage our economy. In spite of all the comments that are being made, how well we're doing, we have the highest debt to total GDP ratio versus almost every other country in the world. Now think about that. There's some pretty lousy countries out there that are running deficits and everything. We have the highest ratio. We're accumulating debt at a faster rate than almost every other country in the world. Even Russia, which does not exactly have a great economy, has a debt to GDP ratio that is well under 50%. And we're whipping along at a much higher ratio than that and are likely to go even higher forward. The most recent Treasury auction was a total bust. In the past, about 40% of our treasuries were sold to offshore investors. That number is going down because they don't want to have treasuries any longer. So at the long end of the treasury curve, 30 years, that was not a good situation because we had a heck of a time being able to sell long-term treasuries. Most of it's been at the shorter end of the curve that we've been able to get done. I talked about the fact that deficits are likely to accelerate in the next 10 years as more people take Social Security and Medicare coverage. I'm going to show you a chart in a second that's going to scare the bejeebers out of you. What's going on with Medicare and Social Security. And then the last thing, debt service payments in the future are going to be much bigger of the national budget, and cuts are going to be coming to programs. And my question is Congress going to have the political willpower to address this problem going forward? I'm not so sure about that until there's a major problem. And that's very disconcerting to me as to how fast these deficits are going to accumulate in the next 10 years. So this shows what's happened going back to about 1950. And we were sailing along in pretty good shape. Then in 1971, we come off the gold standard, as I mentioned. We have the oil crisis in 1973. Ronald Reagan comes in about 1980, and we actually didn't too badly in that period of time for at least a year or two. And then, of course, we hit the dot-com bubble. We all remember that. We have the 2008 financial crisis. And then we have 2020 when we get into COVID. All of this represents the devaluation of the currency. In other words, your dollars are worth less than they were before. So M2 growth contributed to that. Tax cuts, loss of confidence, excess spending has been a major contributor to the problem. And there's no way around it. You got to blame Congress for what's happened here and not having the political willpower to address this issue. This is another chart that I really like because it kind of shows where we are today versus how we spend our federal budget versus where we're likely to be in 2033. And if you look at that and you look at what's been going on, you see the increase in interest. You know, we're up to about 1.5 trillion now versus, excuse me, in 2033 will be at 1.5 trillion versus roughly about 700 billion now. If you look at Medicare over here, you see a rapid rise in Medicare from well under a trillion. By 2033, we're going to be roughly at a 1.5 trillion. Obviously, with more and more people moving into that age group, you're going to spend a lot more. And I'm sure you, like me, when I see how fast my Medicare bills are going up, my premiums and so forth, it's a little frightening to see what's been going on in that area. If you look at another one which has to do with non-defense discretionary, you know, that's going to go up a little bit. But here's Social Security out to 2033, and you see the rapid rise in that. We're going to be somewhere around 2.5 trillion in 2033 versus about 1.5 trillion now. So Social Security and Medicare are going to play much bigger roles in the federal budget going forward. Joe Biden's recent proposal on the budget, he has a 1% rise in defense. That's all. In real terms, that's negative. Because if you build in inflation, defense spending is actually going to be less going forward. In spite of all the things that are going on in the world, we're not going to be putting as much money into defense. And there are some of us who have some concerns about that, given the problems around the world. I saw a story the other day that we can't recruit enough people for the services today because of the attitude of young people about serving in the military. And I'm going to share some numbers with you in a second about what's going on there. Here's another way of looking at it, which I think is a great chart. That blue line at the bottom represents interest costs going forward. The Medicare line is the second one, and you see that there's a rise in that. It'll level off a little bit here. The reason it's going to level off is that people like me may not be around at that time. And the baby boomers are going to begin to disappear. And so we may see some modest improvement in that situation. But look what goes on with Social Security. Social Security is going to continue to rise. And here's the net interest thing on the federal debt, which will become the biggest part of the budget going forward by the year 2048 or 2050. I mentioned earlier about the CBO, the Congressional Budget Office, sort of a nonpartisan agency that does estimates going forward. I look at the most recent report of saying that by 2055, we're going to have $150 trillion plus deficit. I can't even imagine what that would be like. It's hard for me to conceive that they would allow that to take place. $150 trillion deficit would so overwhelm the federal budget that I'm not sure how we would survive in that situation. Anyway, that's a little disconcerting to think about what might happen. So I asked this question, are we accountable? Interest costs are going to crowd out a lot of other priorities going forward. You see, I projected out to, I have this chart that projects out to 2052. Something like 40% of the federal budget will be going toward interest costs at that point. We're not even close to that today. And if that were to take place, lots of other priorities, whether it's defense, Social Security, Medicare, you name it, other discretionary programs are going to be in serious trouble going forward. So anyway, it's an interesting thing to look at. I mentioned earlier about this de-dollarization movement. There are a number of countries that are attempting to get the US dollar eliminated as the reserve currency. Not surprisingly, it's countries in India, China, Brazil, and Malaysia. The Russians were part of that at one point. They've kind of fallen out of favor, so they're not as much of an issue at this point in time. So if that were to happen, the value of the dollar would go down even faster in the future if it's removed as a reserve currency. Now, I'm not predicting that this is going to happen. You know, there's enough countries that probably are going to have some problems with this, particularly those countries who hold US treasuries and their accounts and so forth. But it's beginning to gain steam. More and more countries are talking about eliminating the US dollar as a reserve currency. What's it going to do if that were to happen? It's going to make imported items much more expensive. So if you buy things that are made in China or Russia or anywhere else, they'll become more expensive. It could encourage exports, maybe. There's a real question mark surrounding that. My concern is that it's going to lower the value of financial assets. So things like the stock market, the bond market, other kinds of investment things here in the US will be adversely impacted if we were to be removed as the primary reserve country, the currency here. One other question I would say is how much? And there's no answer. If we get eliminated as the primary reserve currency, it's hard to predict what impact that will have on the stock market or any other investments here in the US. That makes me a little bit nervous. I mean, there's enough other things going on in terms of things that are affecting our stock market and bond markets and things of that nature. That would be very disconcerting, to say the least. So I asked this question, what is the solution to all of this? And I've thought a lot about this over the last 6 months. I got to tell you, I don't really have a lot of good solutions for this going forward. I love this quote from Milton Friedman, who says there's no such thing as a temporary spending program. Every time we pass a temporary spending program, it becomes permanent. And I laugh about it because when you see these new proposals coming from either the Senate or the House, they all say, well, this is a 1 or 2 year program. And what I see is that these 1 or 2 year programs become permanent. Here's a stat that'll blow you away. In 2105, we had 1,000 government programs that we were supporting. That number today is 2,200. Is it a surprise that the deficit is going up? We go from 1,000 programs. Almost all of these are entitlement programs. And we're now at 2,200 programs many of these programs were supposed to be 1 or 2 year programs. They've now become permanent and they get budgeted again basically every year. The other big thing is having to do with M2. I didn't define that earlier, but M2 is basically the broadest measure of the money supply. It takes into account all currency that's circulated, along with demand deposits and other things. I mentioned to you earlier about how fast M2 went up in 2020. There are no guidelines as to how fast the Federal Reserve can increase that. Congress has no control over that. If Jerome Powell, the head of the Federal Reserve, decides that he wants to significantly increase the money supply, and the Federal Reserve Board of Governors goes along with it, he can do whatever he wants to do. He wants to increase it by 15, 20, 30, 40%. It's pretty easy to do it. And that is, in my opinion, very dangerous to have a situation where that's not more closely scrutinized by the federal government and so forth. So anyway, M2 is a big issue, and it's coming down a little bit, but not very much. I alluded to this earlier, but people in Congress need to understand that deficits have long-term consequences. You know, when you run a $1.5 trillion or $2 trillion deficit every year, that's going to have an impact on a lot of different things. And it's fine to occasionally you're going to go through a recession or something of that nature. We all know that in a situation like that, you got to spend more money to get yourself out of that. But when you do that, when you're being told that the economy is just doing fine and don't worry about it, and you're going to run a deficit year after year, at some point in time, that's going to be problematic. The interest costs on that debt continue to go up every year and take a bigger and bigger slice of the federal budget. That means money is not available for other kinds of programs. Now, it's fine when you're at 10 trillion or 20 trillion. We're now at 34.5 trillion. We're headed to 36.5 trillion by the end of this year. What's going to happen if 10 years from now, we're at 50 trillion? What's going to happen if the CBO estimate is correct, that by 2055, we're at 150 trillion? The interest costs on that are going to be astronomical, and it's going to cause a lot of programs to get into serious financial trouble. And I'm talking about things like Social Security, Medicare, other government programs, and so forth. So anyway, I'm worried that we're not focused on this problem right now, because I don't think that Congress wants to deal with this. Yeah, you know, the name of the game is, if you're serving in the Senate or the House, is to get yourself reelected. Well, are you going to get yourself reelected if you talk about cutting programs or raising taxes? Probably not. And until we have a real serious problem, I'm a little concerned as to whether or not we're going to be willing to take this on. I talked a little bit about policy options going forward. I think this could affect the standard of living in this country if we don't deal with this. I talked about the entitlement programs and how fast those have increased. I just saw the other day that there are about 6 or 7 new entitlement programs that Congress is debating right now. That's on the top of the 2,200 we have right now. It's going to get very expensive, to say the least. Here's another thing that I happened to pick up just recently that I'm very concerned about. 60% of young people under 30 do not have a favorable view of capitalism. All of us who are over 60, you can reverse those numbers. So those of us who are part of the baby boom generation generally have a positive view about capitalism. younger people do not feel the same way about our system, what does that say about what we're going to do going forward? If they don't believe that capitalism is the right direction to go, and they're much more comfortable with entitlement programs or not working as hard, what does that say about the direction of our economy going forward? I just had a conversation with a couple of young people recently, and one of the comments that was made to me is that capitalism has failed us. We got to go in a different direction. My comment to them is, what direction do you want to go? Do you want to go in the direction of socialism? That has some issues too. Another interesting thing that came out of that conversation is one of these young people said to me, "Do you know that 50% of college graduates today, when they get out of college, they don't believe that going to college was worth it? There are something like 30 or 40% of college graduates who are minimum wage positions. And when you look at the amount of tuition they're taking on, you wonder how in the world they're going to pay this off. We have $1.7 trillion of debt, college tuition debt, that's sitting on the books right now. How do you pay that off when you're earning a minimum wage going forward? I mean, I don't get it. And so there's a real question. I saw the other day that there are 4 or 5 major universities who've all increased their tuition to $95,000 a year. And you can guess who they are: Harvard, Yale, MIT, some of those programs. Now, obviously, some of those students are going to get financial aid going forward, but can you imagine $95,000 a year? I think my first year in college, around 1965 or 66, I think my total tuition for the year was $1,000. I can't even imagine how these young people are dealing with this today. So anyway, this to me is a really disconcerting thing, because when I look at the fact that 2/3 of the federal budget involve entitlement programs, and that number is likely to grow going forward, how are we going to handle that? If more and more young people have a negative attitude toward the economy, and they don't believe that hard work pays off in that, does that make that situation even worse going forward? It's very disconcerting, to say the least. The last point I would make is Congress going to have the resolve to deal with this? Are they going to be willing to consider tax increases? Are they going to be willing to consider some kind of a wealth tax? I saw the other day that the state of California is proposing now that your electrical bill is no longer going to be on how much you use. It's going to be based on your wealth. So you're gonna have to file a net worth statement every year to determine what your electric bill is going to be going forward. Well, that ought to be easy to do. Can you imagine trying to monitor that? I'm betting that there are going to be a lot of financial statements that are going to show a decrease in value going forward if they're going to base it on that. Anyway, you have these proposals that are floating around. I don't see how any of this is going to contribute to growth going forward. I'll share some other information about this in a second. So I labeled this debt, and more debt. Jamie Dimon, who's the head of JP Morgan, he says, we're all addicted to debt. Consumer debt's going up, federal debt's going up, student loan debt's going up. Stanley Druckenmiller, who's a very good financial manager, hedge fund manager, he said, we're spending like we're drunken sailors. Everywhere you look, people are taking on credit card debt and that. And at 25% plus interest rates for credit card debt today, that's not insignificant. $6,500 is the amount per consumer in credit card debt today. That has gone up over $1,000 in the last couple of years. It's going to go up some more. Student loan debt, I pointed that out, 1.7 trillion. Car loans, 7 to 9% interest rate. Installment debt is now the highest ever in this country. And we're surprised that people are in trouble and that most people have seen no improvement in their net worth during a time where the stock market has gone up significantly in the last few years. Unless you're at the top of the food chain, you're not benefiting from all of the stock increase. I saw a number this morning that that 2/3 of the American public have less than $30,000 in net worth. I can't even imagine what they're going to be faced with going forward. How are you going to retire when you have that few assets? Well, you're not going to do it on Social Security, to say the least. And so the inequality in terms of net worth in this country has gone up significantly in the last 10 or 15 years. So the people at the top of the food chain are doing just fine. It's everybody else that's suffering. So again, I asked this question, tax increases. Are we going to have to move to a wealth tax? I've heard that discussed more often. But then I look at that wealth tax and I say, well, who's going to administer that? I mean, the IRS has a hard enough time just auditing tax returns. Are we going to expect them to audit financial statements, net worth statements, and things like that? That's going to be a real challenge going forward as to whether or not we're going to have the resources to be able to do something like that. So back to this one. Are we surprised that people are in trouble financially? This is affecting confidence. You look at today, whether or not people are feeling good about the direction of the economy and that. I think 2/3 of the people feel we're going in the wrong direction right now. And it's not surprising, in spite of all the good things that have happened with the stock market and that people still have a pretty negative view about what's going on. So I use the term sugar high right now to describe this situation. It's not as positive as what people would suggest. So I love this quote. I'm an old man and I've known a great many troubles, but most of them never happened. It really is the truth. I mean, we can worry about all kinds of different things going forward. And in that context, I want to talk a little bit about some other numbers, and it has to do with cities and so forth. I noticed the other day that the gentleman who is the mayor of the city of Houston says we are technically 6 months away from bankruptcy. The city of Houston, Texas. If you look at New York, Chicago, Denver, Colorado, there are a couple of others. They are in very serious financial trouble. I was looking at Moody's. They now estimate that the probability of default in New York is 75% in the next 2 years. That's a pretty big number. Chicago is 65%. Portland, Oregon, of all things, Honolulu is in serious financial trouble. New Orleans is somewhere between 50 and 60% probability of default. Philadelphia is in trouble. I'm sure many of you read about what's going on in California. They have about, I think it's somewhere between 70 and 75 billion deficit. They're trying to figure out how they're going to pay for it going forward. They still don't have a good solution. They're going to talk about increasing taxes, trying to cut programs and that. but $75 billion for the state of California is a lot of money. They've lost 500,000 residents in the last 2 years that are leaving the state. They just passed something in a couple of the counties in Los Angeles that if you move out, you pay an exit tax. Think about that. I mean, I think I'd think about moving too. If I knew I was going to get hit with an exit tax for leaving the state, they're going to exacerbate this problem even further going forward. So one of the questions that I allude to here is, if you have all these cities that have serious debt problems, and you load that on top of the problems that the federal government has, what does that say about the situation we're in this country? I mean, it is somewhat disconcerting to say the least. I'm going to take it a step further, though. I started looking at pensions around the country. This is one of the scariest things I've ever seen. There are only 2 states in this area that have state pension programs for the employees that are fully funded. All the rest of them are underfunded. New Jersey, their state pension program is 24% underfunded right now. They're at the top of the pyramid, but they're not the only ones. Michigan is about 7 or 8% underfunded. The state of Illinois is about 15% underfunded. The state of California is up in that 10 to 15% range. Now, these are all state employees who are counting on getting their pensions going forward, and they're underfunded at the very time that stock markets have been doing so well. You know, whether it's the NASDAQ or the Dow or whatever, have done really well in the last few years, and they're still underfunded. And my comment to that is, think about it. You've had the Magnificent Seven stocks that have accounted for like 75 or 80% of the growth of the NASDAQ and the Dow. Everything else has languished. So if you were in a stock index fund the last couple of years, you didn't do all that well. In fact, many of them actually are worth less than they were 2 years ago. So unless you were in the Magnificent Seven stocks, you didn't do that well. By the way, that 7 now has been brought down to 4. Because 3 of the companies that were in the Magnificent Seven have been taken out. And so there are 4 companies now that everyone is focused on. And you know what the names are. I mean, you know, the Microsoft and a couple of others I can't pick up on right now, but I think it just shows that the breadth of the market has not been that good. If you were in small cap stocks the last couple of years, you got totally eviscerated in terms of market gains and so forth. They have done very poorly over the last 2 years. Not surprisingly, a lot of these pension funds are in those kinds of index funds and things like that. So they're in very, very serious situation right at the moment. So back in 2015, I did a presentation for the American Economics Association in Des Moines when I was still living there. And I thought, you know, Kunnen, you better be careful about what you say to these people. If you start predicting things and so forth, you can bet this is going to come back to haunt you. Somebody's going to remind you that if you were predicting the direction of the market or the economy or whatever, if that doesn't happen, you're going to hear about it. So I said them at the end, those of us who come out of economics, we predict a lot of gloom and doom. It's one of the reasons why we never get invited to parties and so forth. You know, go to a party and somebody says, "So where's the economy going?" Well, you know, things are not looking very good and so forth. Well, that's the last time you're ever going to get invited to a party. So I put this line in here. I said, those of us who in economics, we predicted about 6 of the last 2 recessions. We're pretty good at predicting how bad things are going to be and so forth. So the only thing I would caution you about all of these things having to do with debt, the buildup of debt, and what it means for the economy and so forth, there are things that can change. If Congress, whether it's the Senate or the House, or the state legislatures begin to address some of these issues, they still have some time to get some balance, to keep it from getting out of hand. The question is whether or not they have the economic resolve, the policy resolve to be able to address some of these issues. Right now, I don't see it. When I look at the lack of bipartisanship, whether it's in the Senate or the House, it just doesn't seem to be happening. We lost a very fine former senator this past week, Joe Lieberman, who had a serious accident at home. I think him, John McCain, and others who always had the ability to work across the aisle. Where is that today? All I see is the people on the far right and the people on the far left calling each other names. And I don't know how you ever get anything done if you don't have some consensus where groups get together and talk about how you can address some of these issues. And I see more and more voters are either going way right or they're going way left. I have a friend in Des Moines, a former golf pro. I don't even know how to describe him. Still a good friend so far, but he is about as far right as you can be. And he basically will say to me, he said, we need to have another civil war. And I'll say to him, Gary, are you crazy? Think about that. We know how well the first one worked. And you got to have some consensus. You got to have parties that are willing to sit down and talk about some of these issues and that. But he is so totally removed from the reality of what's going on that he doesn't have ability to think about what the consequences are if we don't figure out a way to bridge some of these divides between the 2 parties and so forth. And I'm really worried about that, the extreme right and the extreme left. And all of us who are in the middle, you know, we might be center right or center left or whatever, we're totally ignored. You know, you got the strident people on both sides. Those of us who are kind of in the middle one way or the other, nobody listens to us. That's a little disconcerting to say the least. So I have some concerns as to whether or not we're going to be able to reach some consensus on this, but I haven't given up hope yet. I'm hoping that at some point here in the next couple of years, we begin to get some of this and people recognize how serious some of these issues that we are faced with. And I don't care whether it's consumer debt. I don't care whether it's underfunded pensions. I don't care whether it's federal debt. We need to begin to address some of these issues or we're going to be faced with some serious problems going forward. And as I mentioned to you earlier, it's not going to be us so much. Those of us who are over 60, I don't think it's going to affect us. But I worry about my son. I worry about other kids in that next generation of what they're going to be faced with if we don't come to grips with it. I worry about that group of younger people under 30 who have such a negative view toward capitalism. They're looking at all of this and saying, this system has failed us and we got to go in a different direction. The problem is they can't answer what direction they want to go. They just know they're not happy where things are headed right now. So anyway, these are some of the concerns that I have about this debt situation in this country and what's happening in our economy and so forth. But I'm interested in what you think about this. I kind of give you some ideas on what I think, but I'm curious as to how you feel about all of this. What are your reactions to some of these numbers that I've shared with you?
I see a lot of people that are concerned about this and a lot of people that are not concerned about it. And my metaphor would be riding a horse where a selfish kid's running the horse in the ground. And he's keep on being told, you're going to kill the horse. You're going to kill the horse. No, I'm not, because his experience doesn't tell him that. So he just keeps on riding for his own selfish reasons. And nobody has been strong enough to stop the kid till the horse croaks. And so the economists remain concerned, and the people in power show zero evidence of being concerned at all, despite lip service. And so to me, it's insoluble. It's nice that economists are hopeful. I think the horse is going to die.
Oh. I agree.
I have a good friend that I work with, very well educated, has a doctoral degree, but he didn't get the economics genes, and he just doesn't understand economics. And we've talked about the national debt, and he causes me to believe that there are a whole lot of people out there who just don't have a clue, don't understand the impact on the currency, the impact on all the things that you talked about, and that's harming us. I mean, he asked me whom do we pay? I mean, if we're $35 trillion in debt, I mean, whom do we pay to solve that? Well, that's not the right question. So there's a whole lot of ignorance out there, even among well-educated people who just don't understand economics.
Yeah, as I alluded to earlier, I think whoever wrote this piece in the Wall Street Journal, that whether you're in the Senate or House, if you're going to propose a new program, you need to show what that number really looks like. If I say, well, this program's going to cost 700 billion, you know, I get it that some of us who have been at this, we look at that number and we say, oh my God. And what happens if that 1 or 2 year program extends into 5 or 10 or 15 years going forward, which is a high probability to say the least. And I think the idea that this person advanced is that if you propose a program like that, you need to show it in totality. So if we say that we're going to have a $1.7 trillion deficit, you need to put all the zeros behind it and show that to people, because that will get their attention more than just saying 1.7 trillion. I mean, it sounds kind of crazy that you have to do it in that fashion, but sometimes people have to see the magnitude of what that looks like. And I thought it was a wonderful idea to suggest that it be done in that fashion, because everybody throws these numbers around. You know, we're going to have a $1.7 trillion deficit. Okay, I get it. It sounds like a big number, but you show me that with all the zeros behind it, I might have a totally different impression of that. Or if you say to people, this 2 or 3 year program that's being proposed is unlikely to be a 2 or 3 year program that's going to be permanent, suddenly the magnitude of that goes up significantly. And as I said earlier, the number of short-term programs that have been passed, and there's a strategy involved. If I propose a bill and I say, this is a short-term spending program, it's going to be around for 2 years, more likely I'm going to get support. People are going to say, yeah, we can live with that. You know, we can fund that for a couple of years. But if I tell them that this thing's going to go on for 5 or 10 or 15 years, they might have a totally different perspective. Going from 1,000 programs 10 or 15 years ago to 2,200 plus, that is huge. And almost all of them are entitlement programs. If you're not in an entitlement program today, you're really unusual. Seriously. I mean, if you can't find an entitlement program that'll give you some money, you're not working hard enough. And that's a little disconcerting to me. Here's another number that I saw that something like 40% of eligible working males, I'm not going to pick on the females, by the way, they seem to be doing just fine, that 40% of eligible working age males are not working today. They've disappeared. They're involved in an entitlement program or something along those lines. That just blows my mind that people are comfortable in being unemployed like that. What do they do? They sit around all day and watch television? I suppose if they were playing golf all day, I'd be comfortable with that. But that's very disconcerting, to say the least.
I have a question. The comment at the bottom of that is a little farcical. How, can you explain that?
How's
Economists have predicted 6 of the last 2 recessions.
Yeah, that was my line. When I gave that talk to the American Economics Association, I wanted to say to them, just be careful. I could be wrong too about what I'm suggesting might happen. And as a profession, economists can come out with some very bold predictions. All you have to do is look at when they issue a new economic report every month. Everybody has a different opinion about it. What does this mean? How is this going to affect the economy and so forth? Well, by definition that many of these people are going to be wrong about where things are headed. And so I threw this in that talk I gave to the American Economics Association, because I wanted them to remember that the things that I was saying, that I was predicting, things can change. Circumstances can change. And as a profession, we have been notorious in making all kinds of predictions about where the economy is headed and so forth. And I would say that more than half of them are wrong about where we're headed. 2 years ago, a lot of economists predicted that the rate of inflation was going to continue to be elevated well above 6 or 7% for many years to come. Well, we're suddenly down to 3.5% right now. Is that going to change? Is that going to continue to go down? Or is it likely that we're going to see some acceleration in that going forward, particularly when the Fed may or may not cut rates going forward? You remember that just a few months ago, they were predicting that the Fed was going to cut rates 2 or 3 times before the end of the first half of this year. No longer. Now everyone's saying, well, they may not do anything at all this year. We may drift into 2025 before the Fed cuts rates, because we're not coming down to that 2% target that they have right now. So all I'm trying to point out in this is, yeah, I'm pretty good at doing the same thing a lot of other people. I'm saying, this situation with debt and so forth is a big problem. I could be wrong. I don't think so, but I'm concerned enough about how fast these deficits are growing and what it means going forward that somewhere along the line we have to address this. One of the questions may be, is Congress going to be willing to take this on in the next year or two? I'm not sure that's going to be the case. The longer we wait, the bigger problem it's going to become.
I've got one from one of our people online. And this goes back to early in your presentation. The person said, and yet many other experts say that debt is not a problem because we have the capacity to reduce it quickly. Don't ask me how, but that is the answer. What do you say? And then they also added just below that, they said, remember, Trump gave a tax break to wealthy people, lost income.
Well, I'm certainly not here to support these tax cuts that were made a few years ago, and I would say that there are a lot of very wealthy people in this country who don't need a tax cut. And in fact, there was just a story the other day that there were a number of individuals. Well, these individuals are worth hundreds of $1 millions, in some cases $1 billion in that, and they were all advocating for higher taxes on them. I applaud them for recognizing that there's some real problems in terms of inequality of income in this country. What I would say is that we don't have choice. We've got to be willing to look at increasing revenue to be able to address some of these issues in the next couple of years. And as I said earlier, I'm just not sure Congress is going to be willing to take that on. You know, it may be a matter that they're thinking of their own self-preservation. Nobody likes to say, I'm going to increase your taxes. You know, if I say that to you or your taxes are going to go up, you may not vote for me. Unless you think about this as to what the consequences are to continue to run these deficits every year. If I say I'm going to take away one of your favorite programs, I may lose your vote. And the name of the game is to get reelected. So what's going to cause that to change? What kind of situation do we need to have before Congress is willing to address some of those issues? I don't know the answer to that right now, but what I see is a continuation of this pattern that we're just simply going to go ahead and year after year accumulate these deficits. And it's not just the federal government, as I alluded to when I showed you some of these other things. It's the cities, it's the states. There are problems everywhere in terms of deficit situations going on in a number of these cities and that. And I'm waiting for the shoe to drop. What's going to be the first city that's going to declare bankruptcy, that's going to go into technical default? The mayor of Houston, as I pointed out, he said we're just a few months away from a technical default on our bills and so forth. It's a pretty serious statement for him to be making to Houston residents that we're near bankruptcy. When I look at New York, Chicago, and some of these other cities, and the problems they're having, the state of California, what's the next city that's going to get into trouble, or the next state that's going to get in trouble? What's the next big pension fund that's going to run into serious funding problems going forward? If I was working in one of these states and I found out that 25% of my pension fund in that particular state is underfunded, what does that mean longer term in terms of my ability to collect a pension that I'm expecting to live on going forward? So anyway.
Yeah, I have a question and I think we have a hand in this as voters. And I think it really begs to your question about past behavior is a predictor of future behavior, being that all of our congressmen and women have been in there for 40 to 50 years, that lot, and this is where we're at. And I would challenge us as voters to look at candidates that are willing and open to say, I'm going to cut some programs and be open to vote for those candidates. Maybe they say they raise taxes, but continue to drive this train down the track with the current lot of characters. I don't know if it's going to get us to the promised land. That's just my thought.
So let me ask you a question. Let me ask you a question in that regard. Let's say that you're earning $75,000 a year and you're living paycheck to paycheck. And I say to you as a voter, it's highly probable your taxes are going to go up under this plan I'm proposing. What would be your reaction to that?
Yeah, I think it's a healthy balance between cutting those 2,200 programs to narrowing it down to 1,000 or 500 or whatever the number is. And I think we swing the pendulum so far. I think if there's a prudent politician that comes and says, I'm going to shape these programs back. I live here in Holland, right? The last two millages that came through for the school, increasing the millage at the school. And on 152nd, there's a stadium, football stadium that looks like a D2 or a D3 school. I'm like, really? The appropriations of funds to a football stadium that's gigantic and asking for more millage funds. I'm like, something's out of whack. And so I think there needs to be a healthy balance when we look at our candidates and they say, we're not going to increase these entitlement programs. We've got 2,200 of them. And we as voters really got to look at it and say, versus being on the sugar high and getting a candidate that's going to say, hey, I'm not going to raise your taxes. I'm not going to do this to the entitlement program.
But the problem is that we as a society have become more and more dependent on entitlement programs. When you go from, 1,000 programs 10 or 15 years ago to 2,200 today, and then I see this, as I mentioned to you earlier, that there are 4 or 5 new ones that are being proposed right now. You got more and more people who are dependent. Their survival is dependent on these entitlement programs. I wish I was more optimistic that people were going to buy into beginning to move away from some of these things. Once you are getting income from these programs, you're going to be very reluctant to let that go, particularly if you're kind of living paycheck to paycheck, or you're in a situation where you're not working or whatever, and you have to have this in order to survive. So then the answer is, well, let's go after the top 1/10 of 1% of the wealth in this country, or the top 1% of taxpayers. Anybody earning more than 400,000 a year or 500,000 a year is going to pay a much higher tax rate. I wish I was more optimistic about whether they're going to be willing to do that or not. Some of them will be willing to do that. I'm just not sure how big that number is going to be. Until we do that, I must say that I've come full circle on this issue of wealth tax. If somebody had asked me about this 10 years ago and said, would you support a wealth tax? I would have said, not a chance would I support that. You want me to fill out a net worth statement every year? And that's going to determine what my tax rate's going to be and something of that nature? Not a chance. What do you think the compliance is going to be if we move in the direction of wealth tax? I got to be careful what I say about this. I'm going to irritate somebody here, but I'll guarantee you that if we go to a wealth tax, Donald Trump is going to reduce his wealth statement considerably going forward. He's not going to be saying I'm worth $5 or $6 billion any longer. That number is going to come down very quickly to a lower number. And I would guess there are a lot of other people out there who are going to take the same approach. I can't even imagine how difficult that would be to administer if we move in that direction. But there's a side to me that says, unless we figure out a way to generate more revenue, we got to be willing to consider that. There are a lot of different ways of shielding income in terms of reducing your taxable income. And individuals that are in that top 1% or 1/10 of 1%, they have very good tax people that are helping them do this. They're investing in real estate and everything else and taking depreciation and that. If you're really good at that, you can pretty much eliminate all your income by all of these different tax approaches and so forth. That may have to change going forward. However, if you do that, what impact is that going to have on commercial property values going forward? Does that become problematic going forward? The challenges of figuring out a way to increase revenue going forward is going to be really significant. And I don't have a real good answer to do it. As I said earlier, if you'd asked me 10 years ago about a wealth tax, I said, not a chance. These days, I might be open to it if they can explain to me how they're going to administer it. And I question how well that's going to work going forward.
I don't want to be guilty of piling on, but there's an additional problem. I mean, since obviously deficits are the result of revenues being insufficient to cover, well, most of the revenue in this country comes from taxes on either corporations or individuals.
Yep.
the economy is moving in the direction of more and more automation and robotics.
Right.
Which is displacing employment, which is taxable, but robots don't pay taxes.
Right.
Some brilliant people have said we need to go to a value-added tax, which taxes
Mhm.
output regardless of how it's produced, either by machines or by
Right.
people. Do you have any comment on that?
Well, I think that a value added tax might make some sense in some regard. When I look at projections for employment going forward, as you alluded to, it's a little disconcerting to say the least. And right now, we're seeing a situation where a lot of companies are cutting employees. They feel that their profitability is being eroded and so forth, and they're going to do everything they can to shield things up. And maybe a value added tax would make sense in a situation like that. But boy, some of these corporations have enormous political influence. They're doing things that everybody else is doing. They're making political contribution to all of these candidates and so forth. And it might be a little bit of a challenge to convince those candidates to support that kind of situation going forward. So I'm just saying that there needs to be some consensus as to how we're going to increase revenue going forward to be able to address all these funding shortfalls that we're seeing in all kinds of different areas. I don't believe we can continue to run these kinds of deficits indefinitely. And so I don't care whether it comes from a value added tax, or they want to consider doing a wealth tax at some point, or they want to increase the marginal tax rates. If they want to only go after people that are earning more than 400,000 a year, I get that they may need to consider that. But we got to have something, and right now I don't see any consensus in that regard. I see people they're talking a little bit about increasing the marginal tax rates, and if you make 400,000 or 500,000 a year, you're going to probably pay a higher tax rate. If you make more than $1 million, you're going to pay even a higher tax rate going forward. Makes eminently good sense to me. Do they have enough votes to be able to support this? Are they going to be able to get through this through both parties? I'm not so sure about that based on what I see right now. Does that mean you have to have a big swing to the left to be able to get something like that passed? I don't think that's going to happen right now. And so again, I get what you're saying. I want to see some consensus. I want to see both parties come together and agree on something that we can live with going forward. And right now, I just don't see that.
I would make a couple observations. 95% of the voters of America didn't understand a word of what you said today. Worse than that, 95% of the people don't understand what a trillion is.
Yeah.
And I know a finance teacher who gave an example. It takes a couple of seconds longer, but he tells his freshman class, tell us about it. How big is a trillion? And they look at him and he says, okay, take $100 bills and stack $1 million. Tight new bills. How high? And they all look at it. Okay, I'll give you that. It's about 3.5 feet. How big is a trillion? And they guess 2,000, 12,000, 20,000. The answer, 56.5 miles. Now my math maybe, because I repeat
That's
this,
interesting.
but so for the first time I got a feel for what a trillion is. Sorry.
But you think they'd be disconcerted to know that I don't understand about 95% of what I said either?
Yeah, probably not. That's right. Yeah. I think they understand 56 miles.
That's a little self-admission.
It's true. 4 out of 3 people have difficulty with math.
I've got a question from online. This comes from one of our viewers. Scandinavians in Holland are living the American dream. Inequality and debt are generally lower than they are here. Why is this, and what can US learn and change, Bob?
Try that one more time.
Scandinavians, and then I think he means the Netherlands, are living the American dream. Inequality and debt are generally lower there than here. Why is this and what can the US learn and change, Bob?
Well, I would just say that, when you look at how inequality is skewed and that the individuals at the top end of the food chain have seen their net worth go up significantly, where everybody down below has, what are we seeing, their net worth shrink, or they're living paycheck to paycheck, which is about 2/3 of all Americans. And you find out that 2/3 of all Americans have $30,000 or less in savings, if any. That's a little disconcerting because those people are going to end up retiring at some point. How are they going to retire in that situation? I don't get it. And if you believe that Social Security may go through some changes in the next 5 or 10 or 15 years, that's even more disconcerting going forward. So all I would say is that this needs to be addressed. And I get it that, the administration is saying we're much better off today than we were 5 or 10 years ago. I don't see it in the data. When I look at the data suggests otherwise. And, maybe they're looking at different data than I'm seeing, but what I see is more and more Americans getting in trouble and not being able to make it, so forth. It's one of the reasons why we've had this growth of all these entitlement programs in the last 10 years and so forth. And when you look at the homelessness in this country, it's scary of how fast that's been growing. And you look at the fact that people can't afford rents anymore, they can't afford homes and so forth, and our economy is doing really well. I don't see it.
Just a couple of observations. So one, as we look back at what our grandparents and our parents sacrificed, and we can do it with appreciation because they made it good for us.
Mhm.
Our grandchildren, are they going to hate us for the way we live, for what we did?
Yeah.
And as Pogo said, we've looked for the enemy and we found them. It's us. And so much of it, I think, is just a simple lack of discipline. I mean, consumer debt is because people haven't failed to live within their income. As I remember my father keep telling me, remember, you can't eat steak on a hamburger income. And we're trying to do that. And what we've done with the economy, what we've done with the environment, we're not leaving a good situation for our grandchildren.
No, and when you look at the number of our people in our generation who are providing a lot of financial support to their kid. I didn't have my son until my wife and I were close to 40 years of age, so I'm not going to have to worry about grandchildren. He's still single, and so I'm out of the woods on this one. I just got to figure out a way to get him through, and he's on his own with any grandkids he has down the line. But when I talk to people about how much money they're contributing to their kids right now, whether it's picking up their house payments or apartment payments, or they're paying for other things, it is not insignificant. We're being asked, and maybe rightfully so, because we all benefited from pretty good economic times in that, and we've been able to accumulate a fair amount and so forth. But my son, who's is doing really well for himself and that. But when I look at what he's spending on a yearly basis and living in downtown Grand Rapids and so forth, and that even with a 6-figure income, he gets stretched. And so when I look at people giving cars to their kids, they're picking up half the house payments, all kinds of other things. We are doing wealth transfer. As I refer to it, as it's estate planning. And at least if you give them the money now, you're going to be able to enjoy it and watch them enjoy it. But it's not always easy when you're having to write these checks every month to support all these different things that these kids are involved in. And more and more of us are being asked to do it. I'm not going to ask anybody to volunteer to say whether or not you're doing it or not. I can guarantee you I'm doing it. And I don't mind it. We're in a position where we can do that. But it's going to become a bigger issue going forward. So go ahead.
One last question from online regarding pension fund problems. Last big problem, Teamsters was bailed out by taxpayers. That just transfers problem from few to many, correct?
So hit me with that one more time.
Regarding pension fund problems, last big problem where the Teamsters was bailed out by taxpayers. That just transfers problem from few to many, correct?
That's correct. And I think what's likely to happen with some of these states or cities that are underfunded in terms of their pension liabilities, we're going to see more and more of that in the next few years. Where either the federal government or the states and cities are going to have to come in and figure out a way to do this. There are a lot of these cities that I don't know how they're going to get out of this. New Jersey is one of the major states that's having a major problem. But I looked at a map across the country of the number of states that are underfunded. It's 48 of 50 states right now. They're underfunded with their pension liabilities. And it goes all the way from about 24 or 25% with New Jersey, to down to 2 or 3%, which is not a big deal. But again, as I said to you, how does this happen? When you come out of an environment where you've had the growth in the stock market like we've seen over the last few years. I mean, the increases we've seen have been astronomical, and yet you have all this underfunded pension liabilities. Now, some of it is that they invested in bonds and things like that that don't generate as much interest and so forth. But they're going to have to figure out a way to address that, where people are going to see their pension payments slashed in the future. And I doubt very much whether they're going to like that very well.
Okay, well, actually, I got two now. One on your pension. That's because of the loss.
They're what again?
The loss. The law says that if they show a deficit, they don't have to pay towards any pension.
Right.
But when they're making an excessive amount of money, they only have to pay up to a certain amount. They don't have to make up. They're not
Well,
forced to
that's
pay
interesting.
120%.
You think that's true in every state?
Well, I don't know if it's true in every state, but that's the way the pension laws are for business.
Interesting.
Because they're not forced to pay 120% when they're making 150% more.
I'm curious.
That's one
curious,
that I
How many
understand
people
about.
do you
the law.
think actually look at that data on a yearly basis to assess what their pension situation is?
That I couldn't tell you. I don't run the business. You know?
This is just a guess on my part, but I think if you ask most people as to how well funded their pension program is, they wouldn't be able to answer that.
Right.
Hmm?
Oh, no, I understand what you're saying. I
Yeah.
mean, I looked at it because I lost 30% of my pension.
Right.
When I was forced to retire, I lost 30% of my pension just because the way the laws were, and they just, hey, we're gonna take
With the
30% away from you.
with the amount of data I
So-
see from like TIAA CREF, which I've been involved in for many years, and a couple of the others I have, the amount of information I get from them on a yearly basis, I would bet 75% of the information I don't understand, and I come out of the investment
Yeah.
world. And I look at that and I think, oh my, I need to have another glass of wine.
Yeah.
By the
But-
way, I'll never turn down a glass of wine. So,
But my other one was, as you say, Congress, but we also have to have an executive branch that quits giving money away too.
anyway, we're running out of time.
Okay, let's say thank you to Bob.
Thank you very much. I appreciate your interest and so forth. Thank you.